Hey everyone, it's Nick from Dividend here, and in today's video we're going to be talking about 27 quotes from investing greats to make you a better dividend investor. Before we begin, I want to invite you to subscribe to our channel, Dividend, if you're interested in learning more about investing in high-quality dividend growth stocks for the long run. And also, check out the link in our description where you can access our premium online course, Invest Like the Best, which will teach you through case studies exactly how the best investors in the world made their millions of dollars. So the first investor whose quotes we'll talk about is Warren Buffett. Now, this is a person that for most people needs no introduction. Warren Buffett is the chairman and CEO of investment conglomerate Berkshire Hathaway, a company that owns a huge portfolio of $100 billion of marketable securities, as well as dozens and dozens of operating subsidiaries. The first quote we'll talk about is this: "I don't look to jump over 7-foot bars. I look around for 1-foot bars that I can step over." Basically, what Buffett means here is that he doesn't look for challenging home run investments. Rather, he's looking for a repeatable and simplistic strategy that he can do over and over again over time. The next Buffett quote is, "Our approach is very much profiting from lack of change rather than from change." The next 3 Warren Buffett quotes are these: "Time is the friend of the wonderful company, the enemy of the mediocre. It's far better to buy a wonderful business at a fair price than a fair business at a wonderful price." And actually, this quote is repeated from the last slide. "Our approach is very much profiting from lack of change rather than from change." So all of these quotes taken together on one slide basically means that Buffett is looking to buy businesses that are great businesses that he can hold for long periods of time and that will compound his wealth over the long run. The next investor whose quotes we'll discuss is Benjamin Graham, who is kind of considered to be the father of value investing and someone who had a huge influence on people like Warren Buffett and Seth Klarman. The first quote about Benjamin Graham is not actually from him, it's from Warren Buffett, talking about Graham's book, The Intelligent Investor. Here's what he says: "I read the first edition of this book early in 1950 when I was 19. I thought then that it was by far the best book about investing ever written. I still think it is." And that's actually included by Buffett in the foreword to the latest edition of The Intelligent Investor, which I highly recommend you read. The first actual quote from Benjamin Graham is from the introduction to The Intelligent Investor, where he says this: "We hope to implant in the reader a tendency to measure or quantify. For 99 issues out of 100, and by issues he means securities, for 99 issues out of 100, we could say that at some price they are cheap enough to buy, and at some other price they would be so dear that they should be sold. The habit of relating what is paid to what is being offered is an invaluable trait in investment. In an article in a women's magazine many years ago, we advised their readers to buy their stocks as they bought their groceries, not as they bought their perfume. The really dreadful losses of the past few years, and on many similar occasions before, were realized in those common stock issues where the buyer forgot to ask, how much?" So Graham is a quantitative value investor, and you can really see that in this quote from him. He's also the pioneer of this concept of margin of safety, which is outlined nicely in this quote. "The margin of safety idea becomes much more evident when we apply it to the field of undervalued or bargain securities. We have here, by definition, a favorable difference between price on the one hand and indicated or appraised value on the other. The difference is the safety margin, or the margin of safety. It is available for absorbing the effect of miscalculations or worse than average luck. The buyer of bargain issues places particular emphasis on the ability of the investment to withstand adverse developments, for in most such cases he has no real enthusiasm about the company's prospects. True, if the prospects are definitely bad, the investor will prefer to avoid the security no matter how low the price. But the field of undervalued issues is drawn from the many concerns, perhaps the majority of the total, for which the future appears neither distinctly promising nor distinctly unpromising. If these are bought on a bargain basis, even a moderate decline in the earning power need not prevent the investment from showing satisfactory results. The margin of safety will then have served its proper purpose." But Ben Graham was also a proponent for thinking of the stock market as though you're buying entire businesses, and this quote illustrates this concept nicely. He says, "Imagine that in some private business you own a small share that costs you $1,000. One of your partners, named Mr. Market, is very obliging indeed. Every day he tells you what he thinks your interest is worth, and furthermore offers either to buy you out or to sell you an additional interest on that basis. Sometimes his idea of value appears plausible and justified by business developments and prospects as you know them. Often, on the other hand, Mr. Market lets his enthusiasm or his fears run away with him, and the value he proposes seems to you a little short of silly." The next investor we're going to talk about is Joel Greenblatt, who is a principal and portfolio manager at Gotham Asset Management, previously Gotham Capital, a hedge fund. He wrote the 2 excellent investing books, You Can Be a Stock Market Genius, which is a great book with a terrible title, and he also wrote The Little Book That Beats the Market, where he introduced his famous magic formula investing strategy, which is another strategy with a terrible name but excellent returns. So he says this: decisions to buy and sell stocks should be based solely on the investment merits. Now, one thing that definitely stands out about Joel Greenblatt's investment strategy is that he seeks to take away all emotional bias and emotional impact from the investment philosophy. So you can see that in that previous quote we just discussed. He also says this: one way to create an attractive risk-reward situation is to limit downside risk severely by investing in situations that have a large margin of safety. As you can tell from that quote, he's a student of Benjamin Graham. He also says, it makes sense that if you limit your investments to those situations where you are knowledgeable and confident, and only those situations, your success rate will be very high. He also says the two following things about value investing. Prices fluctuate more than value, so therein lies opportunity. And time is the currency of everyone's life. The next investor that we'll be talking about is Seth Klarman, who is the founder of the Baupost Group hedge fund. He says the following about investing for the long term. The single greatest edge an investor can have is a long-term orientation. He's also a proponent for having adequate liquidity, saying the trick of successful investing is to sell when they want to, not when they have to. And Seth Klarman is also known for being a risk-averse value investor, which comes out in this quote: the avoidance of loss is the surest way to ensure a profitable outcome. He's also a believer that although value investing is by definition quantitative, it's dangerous to apply too much precision to those quantitative numbers. He says many investors insist on affixing exact values to their investments, seeking precision in an imprecise world, but business value cannot be precisely determined. Seth Klarman is also a skeptical forensic accounting investor, saying if you don't quickly comprehend what a company is doing, then its management probably doesn't either. Next up is Peter Lynch, who is the past portfolio manager of the Fidelity Magellan Fund, one of the best performing mutual funds of all time. Lynch has a basket of amazing quotes about investing, some of which we'll discuss here. The first is this: owning stocks is like having children. Don't get involved with more than you can handle. Lynch also says if you're prepared to invest in a company, then you ought to be able to explain why in simple language that a fifth grader can understand, and quickly enough so the fifth grader won't get bored. Lynch also says the simpler it is, the better I like it. As you can tell, he's a believer in investing in simple companies with strong competitive advantages. He says, go for a business that any idiot can run, because sooner or later, an idiot is probably going to run it. He also says stocks aren't lottery tickets. There's a company attached to every share. The next investor we'll talk about is Phil Fisher, who ran the family office Fisher & Co. One of Fisher's most well-known quotes is this: in studying the investment record of both of myself and others, two matters were significant influences in causing this book to be written. One, which I mentioned several times elsewhere, is the need for patience if big profits are to be made from investment. Put another way, it is often easier to tell what will happen to the price of a stock than how much time will elapse before this happens. The other is the inherently deceptive nature of the stock market. Doing what everybody else is doing at the moment, and therefore what you have an almost irresistible urge to do, is often the wrong thing to do at all. Lynch also said the following: the greatest investment reward comes to those who, by good luck or good sense, find the occasional company that over the years can grow its sales and profits far more than the industry as a whole. Two other Phil Fisher quotes are: every time you stop in a store, eat a hamburger, or buy new sunglasses, you're getting valuable input. By browsing around, you can see what's selling and what isn't. And this last quote is probably Phil Fisher's most well-known quote. He says, if the job has been correctly done when a common stock is purchased, the time to sell it is almost never. Thanks for watching this video through to the end. I want to instruct you to do 3 things before exiting out. The first is to email me a video recommendation at nick@sharedividend.com. The second is to like this video and leave us a comment telling us what you thought of it. And the third is to subscribe to our channel, Short Dividend, if you're interested in learning more about investing in high-quality dividend growth stocks for the long run. Thanks for watching, and we'll see you next time.